I was not able to attend Super Returns it's SuperReturn International in Berlin in person, but I had the opportunity to join the Africa session earlier this or late last year, and it's just interesting to follow the trends. But I am following what's happening there over the next few days quite closely, and as much as I can from a virtual perspective. But what is clear is that super returns, I think, remains one of the major gathering points for industry. And I think with 2026 happening in Berlin, bringing together really thousands of LPs, GPs, private credit managers, advisors, allocators, and really just the private capital ecosystem. Um, there's a lot of conversations happening around geopolitics, around AI, around liquidity, around growth, private equity, private credit, fundraising, changes in LP and GP relationships. And then, of course, whether private markets remain the powerhouse of global business. I think what's also interesting is not just the size of the event, but definitely the tone around the conversations. And my sense is that Super Return this year is less about celebrating the growth of private markets and much more about asking questions about can the industry convert capital, the complexity and long holding periods, um, and the complexity that this raised around realizing value for investors. Now, for a long time, I think the private equity model benefited from a very supportive um, backdrop. We had low interest rate, so cheap leverage, strong exit markets, rising multiples, focus on globalization and growth, LPs who were generally comfortable backing the next fund while waiting for the previous one to mature. But this has changed. The world has really shifted. And I think if we look at the agenda, but also the conversations being held, I think one of the early sessions was around growth, liquidity, and really the new private equity reality, looking at interest rates, looking at valuations, refinancing, and exits. And then we also see the focus on this disconnect between AI-led market optimism and the stress in the real economy, particularly around credit markets. And over the last few weeks, we've seen a lot of capital or liquidity calls happening and caps being put in place. So I think for me, I think the new private equity reality is really probably the right one to be looked at, and what context that really is. Because really what's being tested now is whether private capital is still relevant. And yes, of course it is, but it's being tested if the old playbook um, is still useful. And as we know, the old playbook relied on leverage, on market timing, multiple expansions, and assumptions around exits that would eventually reopen in a fairly predictable way. But this new environment is much less forgiving. It requires better underwriting, stronger operational value creation, more active ownership, much clearer exit plans, holding for longer strategies, and much more open and honest conversations with LPs around liquidity. And just if I look at some of the media commentary around this, they've relatively been quite quiet around this. When we see Bloomberg and a few other publications frame the message from investors to private markets very, very bluntly, LPs want their cash back, and this is what we're seeing. It was also noted that the value of private equity sales, is down by around 1/5 for the year, which is exactly why distributions and exits are really dominating the conversation. So broadly speaking, I think there's a few themes that emerge, and I think the first one is that liquidity has moved from being really kind of a technical issue now to a trust issue. LPs are not necessarily walking away from private markets, but they are asking much more difficult questions. Where are the exits? Where are the distributions? And how credible are the marks? How much of the value creation is actually real? and how much still depends on future valuation environments that may not actually return. And this, of course, matters. I mean, in an earlier video, we saw also a Bain report coming out about a week ago about the mid-year M&A or private equity and M&A market, which also touched on this around looking at the capital cycle really being stuck. Again, and this is exactly the point being discussed at Super Returns right now. It points to investments, to exits, to fundraising, all dragging in the first half of the year, with liquidity remaining a major challenge. We saw from the Bain report also that it knows that industry has come through a 4-year stretch of record low distributions as a percentage of NAV, and this implied capital cycle now, which implies a capital cycle of around 7 years for buyouts. And this, of course, is not a small issue. It changes the LP and GP conversation. It changes fundraising. It changes portfolio construction. And it changes how boards and management teams inside portfolio companies should think about exit readiness. A stronger GP is no longer waiting for the perfect exit. They're preparing assets early. They're building proof points that the buyers need, and they're demonstrating that earnings, quality, resilience, pricing power, the cash conversion, customer retention, AI readiness, and of course that management depth. And in this market, exit readiness is not something you start 6 months before the sale process. It's part of the value creation plan from day one. I think a second broad theme is secondaries and structured liquidity are no longer side discussions or peripherals. They're really becoming core plumbing of the private markets. So, of course, continuation vehicles, minority stake sales, GP-led secondaries, LP-led secondaries, and structured liquidity solutions are all responses to the same pressure. Assets are being held for longer than expected. LPs need distributions, and not every company can be sold cleanly in today's market. But I think this is where governance becomes really important. A continuation vehicle can be sensible, can be a sensible structure when assets are genuinely high quality and more value can be created over time. But it can also become a way of delaying a very difficult conversation about valuation and ultimately value creation. So the question then is not simply, can we create the liquidity? The question is on what terms and what value, with what disclosures, and with whose interest properly protected. And this is where LP trust is being either strengthened or weakened. Private credit, the third theme, I think, is really, I think, at this stage at an inflection point. Private credit has been one of the great growth stories of the last decade. It filled the gap left by banks, supported private equity transactions, gave borrowers flexibility, and gave investors access to floating rate income. But there too, we've seen this tone shifting. We saw in the market, I think it was Reuters reporting last week that private credit issuance has slowed sharply. US focused direct lending issuance down 40% for the 3 months up to May, compared to the first quarter. Lending to private equity backed borrowers was also down nearly 36%, while direct lending volumes linked to leverage buyouts was also down 34%. So we're really seeing a softer fundraising. We're seeing redemption pressure. We're seeing loan quality concerns. We're seeing renewed competition for cheaper syndicated loan markets. And that doesn't mean that private credit is really broken, but it does mean that the market is being tested, and the better managers will be separated from those that simply erode the expansion of the asset class. And the question now is really not just about who can originate credit, but it's who can underwrite it properly, who can understand the downside risk, who has the discipline to say no, who can manage amendments and restructurings, and who can explain liquidity clearly to investors. I think interesting that the picture is not one way negative. We also saw that Reuters reported that Ares, I think, raised about 8.5 billion for its last fund, above the original 6.5 billion target. We show that capital is still available for strong platforms and differentiating strategies. But we know, and even more so recently, specifically in the US and now spilling over into Europe, that we're seeing capital calls being made, and certain restrictions now being put in place. So something to watch very, very closely. The fourth theme, of course, I guess I'm going to term it as technology, but artificial intelligence. Really being positioned at Super Return this year, not as, well, I was glad to see, not as hype, but really as a valuation and value creation tool. And we saw this from just looking at the agenda, that places AI really right at the center of the discussions. AI versus real economic stress, AI and European value creation, the new world order, global tech, and even whether experience matters in the age of AI. And this is important because AI is doing two things at once. On the one hand, it's creating opportunity. It can improve diligence, customer analytics, pricing productivity, software development, portfolio monitoring, and operating performance. But on the other hand, it's challenging the assumptions that supported some of the most expensive technology and software deals in the last cycle. And here too, we've seen concerns raised around software assets, particularly where businesses were bought at high valuations during the 2021 boom, and now being questioned in light of AI disruption. And the same coverage point comments to some LPs are telling managers they already have enough software exposure, creating what was described by, I think it was Bloomberg, as a free zone for parts of the market. And here too, this is really a shift. For years, software was treated almost as a perfect private equity asset class: recurring revenue, high margin, scalability, customer stickiness, and strong exit demand. Now, of course, AI doesn't destroy that thesis, but it does make it much more nuanced. We're not asking the question anymore whether a company is a software company. The question is whether it's durable, if it has durable relevance in an AI-enabled world. Does it own the workflow? Does it own the data? Does it own? Can it embed AI into the product? Can it protect pricing? Can it improve customer outcomes? And again, this is a very different diligence question. Around, does it do that, or is it a feature that may compress, automate, or replace? And of course, I think, ongoing, the fifth theme that's been coming for a few years now is generally geopolitical and industry strategy. We saw also on the agenda macro geopolitical presentations on the blurred lines between geopolitics, politics, and economics, and what that means for capital allocation, for deal structuring, for exit timings. And some later sessions also focused on volatility and strategic capital, and really the intersection of capital, geopolitics, and industry policy. And really, it's very important because private capital is no longer operating in a neutral global economy. Capital allocation is really shaped by energy security, defense, supply chains, tariff technology, infrastructure resilience, and really national industrial priorities. And that creates risk, but of course, it also creates opportunity. So for investors, I think it means sector selection and geographic exposure matters much more. Portfolio companies, it means strategy has to take policy, supply chains, and resilience seriously. Boards, geopolitics is no longer an external risk buried in an appendix. It's becoming core to the strategy. I think a sixth theme, and I think it's something that keeps coming back, is that private equity is becoming much more operational again. We saw this also from the earlier Bain report had also made the point quite clear that private equity has entered a much more difficult and competitive era with higher rates, stubborn asset prices, less resilience, less reliance on multiple expansion. And it really requires a sharper strategic clarity, strong value creation system, and much better use of technology or AI, not only as a cost lever, but as a source of new product revenue opportunities and better decision making. And I think the last point is important. It's something we also see in the sustainability and ESG environment, specifically from an AI perspective and big data perspective, is having access to more information, the ability to assimilate and work with that information. It's crucial to embed that in the organization, but with the aim for not to just cost cut, not to just report on, but to use it to enable the business as a core capability to make better decisions, which I think is a very, very, very key focus area. And I think generally this is where we see the industry moving to, around strategy, value creation, and systems. Really core focused on what are our strategic capabilities. I think those that will be successful in the current or next cycle is not just firms with the most capital, but it's going to be firms with the best judgment, and really putting pressure on leadership skills, both at the fund level but also at the company level. We need to see a big focus on on a focus on underwriting, clear sector insights, of course, strong operating models, and deep and very close relationships with management. The credibility to tell LPs the truth, not just when markets are rising, but when exit environment remains difficult. So for me, this is the real takeaway from what I've seen so far, and also a little bit of takeaway from what we saw late last year coming into this year, coming out in the discussion at Super Returns at the moment. Super Return is still carrying on for a few days, so I'll see what I can also pick up on over the next few days if there are a few sessions I can attend. But I think what we are seeing that the current market is going to reward businesses that are cash generative, that have pricing power, that are resilient, that has strong management, and that has a credible exit universe. It's going to reward your funds and managers who are preparing early, that are acting decisively, create value through operations rather than relying on market to bail out the model. And I think specifically for your mid corporate and mid market companies, including those. And this is developed and emerging markets. I think global private capital conversations. Sure, it's happening in Europe at the moment, but I see if we look at all the events happening across Africa, across Asia, across the US, etc., all this I think is very relevant. Themes being identified and principles being set, whether you are a small, medium, mid-corp or large listed entity, founder, boards, CFOs, and really investors everywhere. So really some interesting takeaways. That capital is still available, but it's much more selective. It wants clarity, it wants discipline, it wants proof. And I think increasingly it wants this credible path from an investment thesis basis to realized returns. Once again, thank you for listening, and we'll talk soon.